we are going to be talking about the inflation nightmare that is going to continue. This is ultimately the results of the tariff impact. Now, I want to go and review a little bit of Christopher Waller's recent speech because he had something to say inside of that that I think is pretty interesting considering some of the other statements that are coming from the Federal Reserve officials. I linked a couple of articles down in the description, mainly one of the interviews coming out of, Kashkari, and what he had to say in line with what it is that Christopher Waller was also explaining inside of his speech. So let me kind of break this thing down here a little bit for you. In that, in this speech given by Christopher Waller, and for those of you who are members of the lives or members of the channel, we did a live stream breaking this entire speech down. I'm not going to do the whole speech. I'm just going to go to one section of it. And it talks about the issues that we are now facing with the tariffs and what it is that the Federal Reserve is kind of anticipating or expecting from the tariffs. Now, he talks about two scenarios, large tariffs and small tariffs. Now, the large tariffs is basically full-blown tariffs. Everybody's getting like 25% tariff across the board, no exceptions kind of thing. This has already kind of been alleviated. Like, most people probably don't think that there's going to be a full-blown tariff kind of escalation to 25% across the board. Most people kind of see it coming down in a dramatic fashion. Now, let me talk about the first scenario, and then we'll go into the second scenario. Now, in the first scenario, he says, let's assume they, talking about the tariffs, let's assume they remain at levels, at that level, talking about the 25%, remain at that level until at least 2027, which is the horizon for the economic projections made by the FOMC participants. So when asked, with the Federal Open Market Committee, that's the FOMC, they're the ones who vote on monetary policy. Oops, let me cover up my little logo here. So algorithm hates logos. Gotta cover up logos. So ultimately, this full-blown tariff that's going to be implemented, the Federal Open Market Committee is under the assumption that that would last until 2027, and this is going to bring in some major inflationary pressures with it. It goes into the speech. In my view, keeping the large tariffs in place this long would be necessary if the primary goal is remaking the U.S. economy. So now this is where I think a lot of people are looking at the tariffs saying, hey, we're going to try and bring manufacturing back to the United States. This is where the Federal Reserve is actually addressing that exact idea of the goal, right? Of the primary goal is to bring manufacturing back. And he says it right there. In my view, keeping the large tariffs in place this long would be necessary if the primary goal is remaking the U.S. economy, which is now mostly service, into one that produces a large share of the goods it consumes. Such a shift, if possible, right? So like even the Federal Reserve is questioning if that's even possible, or at least Christopher Waller of the Federal Reserve, right? Such a shift, if possible, would be a dramatic change for the United States and would surely take longer than 3 years. I totally agree with that. Like, returning manufacturing back to the United States is going to take generations of people because it took generations for it to leave. So the idea that it can return in a matter of a couple of years, no, I doubt that. And even the Federal Reserve is saying, hey, this dramatic change to the United States would definitely take longer than 3 years, right? And I would assume those tariffs would have to remain in place throughout the entire time in order to bring manufacturing back. Okay, so that's first scenario. Large tariffs, fully implemented, trying to bring manufacturing back to the United States, most likely not going to happen, certainly won't happen in 3 years. Second scenario, this is the most likely one, right? This is more likely what's going to end up happening. In the second scenario, it is assumed that the primary goal would be to use tariffs as a leverage to negotiate reductions in trade barriers faced by the U.S. exporters. That right there, I truly believe, is what the attempt of what is going on right now. That's the goal. Like, not to bring manufacturing back, that's not going to happen, certainly not going to happen quickly. Certainly not going to happen quickly, but if you go in and inflict a bunch of tariffs and then start to negotiate the reduction of tariffs, well, then you can negotiate into reducing of the trade barriers or whatever it is that's happening out there that's restricting the domestic exporters as it is. This is really where they are trying to move the economy into. So again, the primary goal would be to use tariffs as leverage to negotiate reductions in trade barriers faced by U.S. exporters. In this case, while I would expect that announced minimum 10% tariff on all goods from all countries would remain in place. So they don't know what it is that's going to end up happening, but they're going to assume in their economic models and their ideas and forecasts that there is a 10% tariff that is implemented across the board. I would also expect that substantially all other tariffs would be eliminated over time. I would call this the small tariff scenario. So this is something that I found very interesting. It's very much like in the verbiage back during COVID when the Federal Reserve officials were saying once everybody is vaccinated, we can open up the economy again. And I thought back then, I'm like, you're no doctor, you're a banker. How would you know that we can open up the economy again once everybody is vaccinated? Like, you're assuming that to be the case, that if once everybody is vaccinated, then they can open up the economy again. But then I realized, nah, that's not really what it was all about. What it was a timing issue. By the time everybody is vaccinated, then the ability to open up the economy would be there, not because everybody was vaccinated, but because that would be the timing for it. They didn't communicate it that way. They said once everybody is vaccinated, we can open up the economy. And I thought, nah, you don't know that. You're no doctor, you're a banker, and you're just assuming that that would be the case. Very much like this, right? They're assuming that over time, right? I would also expect that substantially all other tariffs would be eliminated over time. So all the credible threat of all these tariffs, not necessarily talking about the 10% across the board, but all the rest of them that are being threatened out there, what he is essentially assuming is that all those are going to be eliminated, right? Now, it continues on. Like, again, I don't want to read this whole speech because it would just take forever. But then he goes in to talk about this second scenario and what that would do to inflation. So this is the critical point, because the idea that the Federal Reserve is trying to get inflation down to a 2% target is pretty much what 99% of the people out there believe. It's the common narrative. The Federal Reserve is trying to get to a 2% target. It's repeated over and over and over again. However, here on this channel, we have shown many times that the monetary policy is seeking to achieve inflation that is moderately above 2% for some time. The reason why they're doing that is to make up for the fact that they failed to achieve the 2% target over the previous 10 years prior to COVID. So since then, they've been in a not necessarily a technical makeup strategy, because ultimately they did have something called the makeup strategy, in which that they were going to let inflation run extra hot, extra long for an extended period of time. But COVID came in and essentially made the makeup strategy irrelevant, since inflation was running already high, and they were in a position in which that they were wanting inflation to be extra high, extra long for an extended period of time, again, to make up for the fact that they were failing to achieve the 2% target over the previous 10 years. That's very difficult for a lot of people to wrap their heads around, but just go and research makeup strategy, Federal Reserve makeup strategy, or even just go and look at the consensus statement, or what they refer to as the monetary, oh gosh, what do they call that? Hold on one second, let me get that right. Oops. They call it, bring it up here, because I always say it wrong, right? I'm not sure why I can't remember something so simple as this. All right. But it's very simple. Titled Statement on Long-Run Goals and Monetary Policy Strategies. This was adopted and effective January 24th of 2002. Oh, I'm sorry, of 2012, and reaffirmed January 30th of 2024. In that statement, it's also called the consensus statement, they said it, in order to achieve, or in order to anchor long-term inflation expectations at this level, talking about the 2% target, at this level, the committee seeks to achieve inflation that averages 2% over time, and therefore judges that when and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation that is moderately above 2% for some time. Knowing that is the real monetary policy, looking to achieve inflation that is moderately above 2% for some time. That then takes me back to this speech that was given by Christopher Waller, where they essentially are assuming that the primary goal would be to use tariffs to leverage negotiations to bring them down, but still have a 10% tariff that is inflicted upon the economy, which is going to raise the inflationary pressure. Now he goes in and talks about this. I know I'm talking fast, guys, but I'm trying to get the information out. Again, the links are down in the description. So this is what he has to say about the second scenario, right? Where you have less tariffs, or the 10% tariff, right? Let me now turn to the second scenario in which tariffs are lower. In this case, I would expect that the 10% across the board tariff would be a baseline for average weighted tariff. Under this scenario, the effect on inflation would be significantly smaller than if large tariffs remained. Here, the peak effect on inflation could be around 3% on an annualized basis. 3%. That's with the low tariff scenario. Right? This is with the idea of hitting the globe, the countries out there with an elevated tariff, like saying, boom, you're going to get this major tariff, but then start negotiating them down to 10%. Right? And then there's this 10% across the board tariff. They're assuming that to be the case, but with that assumption, they also assume that if that was to be the case, there would be a 3% inflation rate that would be happening, right? Here, the peak effect on inflation could be around 3% on an annualized basis. Now, they don't define moderately above 2%. Is 2.2, 2.3, 3.1? Is 3% annualized inflation moderately above 2%? I don't know. But it seems in line with the monetary policy, the consensus statement, that strategy on long-term strategy in monetary policies, right? It seems very much in line with that to have inflation at 3%. And I mean, I don't know if that's moderately above 2. I mean, they don't tell us. So I'm just going to assume 3% is moderately above 2. Since it may take some time for tariff-related price increases to work their way through production change, the peak may be lower but still dissipate slowly. So this is going to be inflation running persistently extra high, right? Because they're trying to get it down to 2% target, not really, moderately above, extra high, extra long for an extended period of time. How many times have I said that in these videos? Going back years, like during the Biden administration, I was saying that the Federal Reserve is going to create a situation, or look, they're not creating anything. They are looking, there we go. They are looking for a situation in which that inflation would be running above the 2% target moderately for some time, higher for longer. This is what the Federal Reserve is looking for. This is what they want, and they are totally achieving it with the help of the credible threats of tariffs. Right? Goes on to say, as trade negotiations proceed, I would expect that expectations of future inflation would remain anchored, and short-term measures could even fall over time, helping keep overall inflation in check. They are looking for this moment. They want it. They are totally being rewarded right now with the credible threat of tariffs that is creating an inflation expectation that is elevated. In the idea of negotiations is going to bring that credible threat of tariffs down to a level in which that the inflation expectations are in line with the 2% goal and moderately above, or the current inflation rate being moderately above 2%, to make up for the fact that they failed to achieve the 2% target over the previous 10 years. Bang. This is lining up exactly the way I thought it was going to. I didn't know they were going to use tariffs. I didn't know that they were going to do all these things and communicate it out there the way they did. What I did know is that the Federal Reserve was going to be looking for a situation in which that inflation was going to run extra hot, extra long for an extended period of time to make up for the fact that they failed to achieve the 2% target over the previous 10 years. They're getting it. They're totally getting it. It's lined up perfectly for them. low unemployment, right? That could change. All this stuff could change at any given time. If you alleviate the pressure of tariffs, you're going to find that that is going to be encouraging for the markets. It's going to be encouraging for the economy and people out there going and deploying their capital investments into the economy if the threat of tariffs is being alleviated. Now, with that being said, that was Christopher Waller's speech. I'm going to turn to a couple of news articles that show this exact thing taking place. Canada offers tariff relief to domestic automakers amid U.S. trade dispute. Canada automakers, manufacturers will be allowed to import specified numbers of U.S. assembled vehicles tariff-free. Right? Already they're coming up with the negotiations and creating the situations in which those tariffs are being eliminated. There we go. And so Canada offers this one up, tariff relief on domestic automakers amid U.S. trade dispute for U.S. assembled vehicles tariff-free. All right, one of the others. This is coming from Kashkari, all right? And now Kashkari had this to say, fast resolutions with countries over tariffs will ease recession fears. See, hit them with the credible threat of tariffs, and then talk about the negotiations that are going to alleviate the problem, leaving a situation within the economy that is perfectly in line for what the Federal Reserve is looking to have for their monetary policy, which is elevated inflation expectations and elevated inflation. Elevated inflation meaning moderately above 2%. Elevated inflation. Kashkari goes on to say here, let me see if I can read some of these quotes. It's really going to be determined by, are there quick resolutions? Are there quick resolutions to these trade uncertainties with our major trading partners? This is the question that everybody has. Well, it's obviously coming to that fruition, right? I mean, talk about all the flexibility negotiations, even Canada, just with this article coming out, the whole idea of 25% lumber tariffs, how was eliminated? China's electronics, those tariffs are eliminated. You can see already the pressure is being alleviated throughout all these tariffs. I suspect that at the end of this, we would find a situation in which that elevated inflation is going to be within the economy right in line with the moderately above 2% target or 2% strategy that the Federal Reserve is looking to do. This is lining up. It's like almost perfect. And I think the speech actually clarifies that. Talking about heavy, what would it be like if there was full-blown tariffs? And that the idea behind that is to bring manufacturing back to the United States, which is a very unlikely scenario and would take much longer than 3 years. Then there's the second scenario, which these elevated tariffs are being used as a credible threat for negotiations to bring those tariffs down and to alleviate the trade barriers that a lot of these domestic United States exporters are facing right now. That's what I truly believe is taking place, is that they are going through those negotiations. They don't truly want to hit the United States with these, or hit the other nations with these major tariffs. And the goal of bringing manufacturing back is like, that's not really a goal. That's not really possible. Right? Even the Federal Reserve was saying, if it's even possible, right? I mean, that is going to take years and years down the road, and I believe that the people would have to suffer with incredibly high inflation, incredibly high tariffs, and that painful experience of the people would not be well received by the right? The administration would be suffering and disapproval ratings that are already in the toilet, right? So there's no way that that's, like, in my mind, the environment of which that would be so frustrating for the people to have to go through that they just simply would not be accepting of it. Scenario number 2, negotiations, bring tariffs down, slightly elevated inflation going into the future, right in line with the monetary policy of the Federal Reserve. Like, yeah, that's the way it's going. That's the way it's going to end up going down. Okay, 20 minutes into this, let's go read through some of these comments here. And all right. Central banks go back like 300-400 years, I think. All right, let's cruise down to some of these. I just kind of picked a random one out here, really, with the question mark. Central banking established itself in London under the direction of William Patterson. It enabled the king to go into debt for war without taxing the citizens of England. Definitely something going on. Gold jumped approximately $112 today. I know, that was incredible, right? Holy cow, gold is on the run for sure. Yep, it is. And what I think a lot of people are looking at the gold as like the fear and uncertainty and doubt that's out there. They don't know what's going to happen with inflation. They don't know what's happening with these tariffs. There really is no safe haven to go to out there except for gold and maybe a lesser extent Bitcoin. So gold is going to be the place to go to. Once the alleviation of tariffs has started to become more persistent within the economy, like people are looking at these negotiations being more prevalent within the economy, like the reduction of tariffs. Once that starts to happen, I think that's going to take a lot of that excitement out of gold and probably move it back into treasuries and the dollar. Yeah. But I think it's the fear and uncertainty and doubt of tariffs right now that is keeping that from happening, and then it pushes people into gold because there's really no other place to go to. All right, guessing a judge will put a stop to all this tariff chaos, at least temporarily. I don't know. Ray Dalio and Jamie Dimon both not too keen on the health of the economy. Something is not right in a big way. Tom, I think that if you just kind of look at what I was saying today, I think this is more likely the scenario that is happening right now. Push the credible threat of tariffs out there, alleviate a lot of the tariffs, leaving some in place to have an elevated inflation within the economy so that the Federal Reserve could be in line with their strategy, which is moderately above 2%. Like, to me, this is lining up very well. The chaos and the uncertainty that is being pushed by Ray Dalio and Jamie Dimon, this is part of the credible threat. They have to push the fear and uncertainty and doubt. If these two guys came out and said, it's not, but yeah, a little concerning, not so bad, not too worried about it, then the fear, uncertainty, and doubt would not be able to be used against the people in order to create the situation that they are looking for today. Like, they want the people to be very worried. If they were very certain, then there would be no use of their words. Like, their words wouldn't work, because if you're certain, then you're not going to pay attention to every single word that they say. But the moment that you are very uncertain, now you're going to hang on it. You're going to hang on every word they say. What's going to happen? What's going on in the future? What's going on with tariffs? Whoa, tell me, right? That's the condition that they want the people in. Like, they're not... To me, this is a very well orchestrated communication style. This is what's going on right now. Think about it. Look at every single Federal Reserve. Go and listen to every single Federal Reserve interview that's taken place over the last 2 weeks. If you cannot find, it will be almost impossible to not find that word uncertainty used in just about every single communication coming out of the Federal Reserve right now. They are pushing. They want the people to be uncertain about the future as part of the policy. Open-ended communication. We don't know. Data dependent. Got to see. Got to wait and see. Don't know. Right? That fear and uncertainty and doubt is how they use their words to push a particular belief or narrative out there within the system. Again, if you are uncertain, you'll hang on every word. If you are very certain about the outcome, you don't care what they say. So keeping you in fear, uncertainty, and doubt is absolutely the way that they are controlling this right now. I don't think Trump's administration respects judicial branch at all. I think that this is all show. I think it's all show. I really do. I don't think there was ever any intentions on bringing jobs back to the United States or inflicting incredibly high tariffs. I think the idea behind it all was to create a situation in which that they could then use the threat of tariffs to negotiate down to a level in which that they would then have the exporters less restricted with their merchandise that they are exporting right now. Like, that's the situation. You're not going to bring jobs back. There's no bringing jobs back. You can create a situation in which that the manufacturers you have here might have a better condition in which to export their goods, but you're not going to bring a job back to the United States and say, hey, all of a sudden we're a manufacturing powerhouse again. That is such a far off idea that is just not. It's like I don't even consider that a possibility, because I know the pain, and that the pain that would need to be experienced for generations of people in order to make that happen is not going to be well received by anybody, right? So there's no president, there's no Congress, there's no Senate, there's nothing that's going to happen out there in which that the people are going to vote for somebody who would do that to them. It's just they won't do it. They'll vote for people who will give them stuff, but they are not going to vote for people to say, hey man, you're going to have to work twice as hard for half as much, pay off your debt, don't move into luxuries, and then maybe somewhere down the road we can have some jobs come back to the United States. Nobody's going to experience that. Nobody's going to want to do that. Hey, right on. Thank you for the 40, I'm not sure what it is you sent me, but it turned out to be 47 cents, so I appreciate it. Thank you very much. EU view on silver considering gold to silver ratio. You're talking about my view on it, the UE view. I look at gold and silver. I look at silver. I'm more into silver than I am gold, right? But then I look at silver as being incredibly undervalued to gold, and so therefore buying into silver is a much better position, with the ratio being like, what is it, 100 to 1 right now? So when they pull it out of the ground at 10 to 1 ratio, and then industrial use takes 50% of that production, that really only leaves 5 to 1 ratio to gold, but yet it sells at 100 to 1. Silver is so undervalued to gold, it's just unreal, right? So to me, like, silver is just like the best position you could ever possibly be in when it comes to that kind of like positioning yourself. It's a speculation, it's not an investment. An investment is something that pays you. A speculation just sits there until you sell it again. That's what silver ends up doing, but there is no better way to get out of that third-party claim. To have something that is separated from the banking system, separated from government, separated from everything out there, there's really no other position that you can take on other than precious metals. And so, in my opinion, silver would be it. Like, there is nothing else. Everything else is secondary to silver. Now, granted, gold has had a dramatic move. Silver has a tendency to lag behind gold, and then is like the insane little cousin that just rips afterwards. So you'll have a much higher move within silver, but it's usually lagging behind gold, right? And again, I'm not trying to convince you to go buy silver. That's up to you. What time is it? Alrighty, guys. Tariffs another way to tax the rich corporations. I don't know. I feel like the Great Depression, you can't tax corporations. Any tax to corporations is essentially an input cost, and it goes down to the retail end of it anyway. So no matter what, the consumer pays it. Like, no matter what it is. It doesn't matter how much you tax, or it's like, I'm going to tax 100% of the profits of the corporations. It doesn't matter. The consumer is still going to pay the tax. No matter what. Like, the corporations don't get taxed. It's an input cost to the consumer, or to their bottom line, and essentially is paid by the consumer. All right, no 20-year-old will want to work in a factory. Negative rates are coming early 26. I don't think so. I think negative rates will come after the cashless society. So we're going to have a cashless society first, and then they'll move into, well, that's not necessarily. We'll have to have a digital currency first, like one that's actually being used. Then, in that case, a digital currency instead of cash can be deployed into the economy, and then cash can have a fee that's applied to it, whether you withdraw it or deposit it at the bank, and that fee would be equivalent to the negative interest rate that is attached to the digital currency. So if that to me, like, if you're going to have negative interest rates, you would have to have two components to it. One of them, a digital currency, and the ability to deny people the use of cash, which means making it a nuisance. It's not necessarily a cashless society, but a cash, like, how would you put it, cash deterrent society, Thank you for settling my anxiety on this. My husband and I are planning on having a baby next year after his military duty stabilizes a bit, but this inflation scare really had me worried. Don't stress it, Aaron. See, the thing is like inflation is only scary to us as individuals who work every single day for our money, right? That's like everybody. But we're worried about our dollar, like our purchasing power. If you take into consideration that the dollar shouldn't hold value, that it's a form of currency, which means that it trades goods and services for other goods and services, and that's all it's meant to do. The moment that we put an expectation on it that says you should hold value, this needs to hold value, you're asking it to do something it simply cannot do. Like it just can't do it. It's not going to. There's no way in the world it can possibly do it. It's a fiat currency. It's going to devalue over time. So to understand that inflation is actually a feature within the economy, it means that you cannot hold on to your dollars for very long. There are times in which that you can hold on to your dollars for purchasing, for, you know, that buying opportunity going into the future. Like, you know, if we run into a recessionary pressure and we all of a sudden start having like deflationary pressures start coming into the economy, well, if you're sitting on dollars, hell, that's like everything is going on sale for you, right? So this is a really good thing that's happening. But most of the time we look at the tariffs, we look at like the central planners out there, and we kind of have this assumption that the inflation is going to be running quite prevalent within the economy. That right there is exactly what the Federal Reserve wants you to believe. They need you to believe that. See, the Federal Reserve is far more concerned about deflation and what to do about a deflationary nightmare. Inflation, hell, they tried to get inflation for the longest time and failed to do it. Quantitative easing 1, 2, 3, and 4 took the balance sheet of $850 billion on the Federal Reserve to over $4.5 trillion. Right? That was a quadrupling of the balance sheet. This last go around, the quantitative easing that went through COVID, it was a doubling. Great financial crisis quadrupled the money or the balance sheet. Far more money printed on a percentage basis back in the great financial crisis than was printed during COVID. Yes, there was more dollars printed during COVID, but there was more on a percentage basis printed during great financial crisis. However, the great financial crisis failed to achieve the 2% target on inflation. Like, they could not get it up to 2%. All this money printing, all this hyperinflation scare, all this, you know, Obama ruined the country talk failed to produce an inflationary scenario that was the goal of 2%. It couldn't even get there. So now the Federal Reserve at the end of 2018 was just like, our problem we need to solve these days is a risk of inflation that is persistently too low rather than too high. So ultimately, they needed a fear and anxiety-ridden people out there to believe that inflation was going to be running extra hot, extra long for an extended period of time to make up for the fact that they failed to achieve that 2% target. And this is what it looks like today. All right? Now, I was questioning it back in 2018-19. I was like, how in the world are you guys going to get inflation? I mean, you just did all this money printing and couldn't do it. And all of a sudden, you're just going to come up with some magical scenario within the economy that's going to have an elevated inflation expectation that's going to totally raise inflation. And then boom, COVID hit. And I was like, wow, that was really fortunate for you, wasn't it, Federal Reserve? That was really fortunate, because you were looking for elevated inflation, and man, did you get it. And you got it in an extreme way. And they're back there going, man, that whole makeup strategy, you can go ahead and put that thing back on the shelf. We don't even need to worry about that thing anymore, because COVID is causing all the inflation that we want. Think about this. At the last, not the speech that Powell gave today, what was it, a few weeks ago, well, a little over a month or whatever it was. At the end of that speech, he gave a Q&A session. Go and listen to the Q&A session of it. We did a video on it and we showed it. In that Q&A section, they actually address the moderately above 2%, talking about the makeup strategy. Powell addressed it. He says, yeah, he says, we did have this makeup strategy, but COVID, like the COVID pandemic, made it irrelevant. Listen to the crowd. There are people out there who start chuckling. They are laughing. He says COVID made that irrelevant, made the makeup strategy irrelevant. They were going to push inflation extra high, extra long to make up for it. This was the makeup strategy. Go read it for yourself. I've done videos on it in the past. This is what they were intending on doing. However, COVID hit, made the makeup strategy irrelevant because inflation was running hot, and the people in the crowd, when they heard that, they chuckled. They were like, "Yep, it made it irrelevant, all right." Like, what were they laughing at? They were laughing at the fact that they knew that they were looking to have elevated inflation, and COVID totally worked for them. They thought it was funny. It was sick. It was sickening to hear. Like, I couldn't believe it. I went back and I'm like, did they just laugh? And sure enough, like, we played it a couple of times. Sure enough, there were people in the audience laughing at that. Laughing at the fact that COVID alleviated the problems of trying to implement a makeup strategy, made it irrelevant. God, I was so frustrating to hear that. But it's also telling. It's also very, very telling of the central planners out there, the central bankers out there, the stuff that they are pulling over the people's eyes. Just something as simple as that. Laughing at the idea that COVID alleviated the idea or made the makeup strategy irrelevant, and they thought that that was funny. It was sickening. What time is it? All right, I got a few more minutes here. We got Tyler Jones with the $20, man. Thank you so much. Thanks for sharing this information and having me dive into the rabbit hole of central banks. Yeah, I appreciate you doing it, man. I have a reading list to go through, including books. May the power come back to the people with knowledge. May central banking power end. Yeah, absolutely. Now, I think really, like, the idea of ending the Fed isn't going to come from suing them. It's not going to come from having Congress do something about it. It's not going to have an administration's effort or anything like that. If you truly want to end the Federal Reserve, you have to dive into this information that I'm diving into. You have to understand it and share this information with your friends and family so that they can also understand what it is that the monetary policy is truly up to understand that they are pushing inflation for an elevated position so that they can make up for the fact that they failed to achieve that 2% target. To internalize that, understand it, and know what it is that they are doing for their policy right now. If more of the people were aware of that, if they understood it, if they internalized it, the Federal Reserve would not be able to operate at the level that they are doing it right now. It would be something totally different. Would the Federal Reserve still exist? Maybe, but they would not be able to operate monetary policy the way that they are doing it right now, because we would be able to see it plain as day, very much like I am describing it right now. I'm the only one who does this, and I don't mean to brag, and I'm not trying to be arrogant, I'm not trying to do anything like that, but literally the Uneducated Economist YouTube channel and the crew here, we are the only ones discussing this in this fashion. Everybody else has got it wrong. Nobody has internalized the credible threat theory to understand that their communications is creating an elevated inflation environment so that they can make up for that 2% failure, that failure to achieve that 2% target. So I appreciate you, sending me the $20 and being here and learning along with all of us, man. Okay, cruise down to the bottom here. I take it you just saw Powell's recent interview. I didn't see it. I was at work. I mean, I saw it popped up here. I knew he was going to be be giving a speech today, and I didn't see the press conference if there was one given afterwards. Again, like, I've been at work all day today, so. All right. What if we actually hold them accountable with elections by the people, give the Fed more power, but hold them accountable with elections? Maybe they become branch of the government. I think that would be a very bad idea, Mona, because here's the problem. I do not trust our elected officials at all, right? Not that I trust the Federal Reserve, but I trust their independence away from our elected officials far more than I trust our elected officials. Like, again, like, I don't trust the Federal Reserve, but to put people in charge who are looking for nothing more than to be voted back into office are not going to make the right decisions. I know they won't. There's no way that they can. And again, I don't trust a private banking organization like the Federal Reserve, but then again, I'm also trying to share information that it can be internalized so that it literally disrupts their behavior and their ability to do what it is that they are doing right now. Like, if there's a way to end the Federal Reserve, I believe that I am doing it, but I do not believe that an elected official is going to do the right thing for me at all, or make the right decisions in general. Like, I just don't trust them whatsoever. Like, I'm more of an anarchist anyway, so like the less government I can have involved in my life, the better, you know. And so I don't want them in charge of anything at all, you know. And I certainly don't trust them to be in charge of the banking organizations. Once again, Wayne, who cares? Trump has no authority to lose people 12% of its income. All right, how come we're repeating history? Seems like Germany went through nearly the same thing during World War I and World War II. I think the difference that you are experiencing, or thinking that what you are experiencing now comparatively to the Germany or the Weimar republics, or even like, you know, the idea of Zimbabwe, hyperinflation, Venezuela, all these other places out there. The difference is that there's never been a country that has established a position with the world reserve currency to the level that we are experiencing today. Okay? I think a lot of times when we see the money printer and inflation and think about our domestic economy, we don't really incorporate what it is that's taking place within the global economy, considering our dollar is the global reserve currency. There is so much demand for dollars outside of the United States that it makes me wonder if that debt was to come due quickly, could the Federal Reserve even print up at a pace that is fast enough to alleviate the debt? Okay? Like the liquidity crisis that can come into the future from the lack of dollars available to the world could create more havoc than any kind of idea. Like, to me, that is more problematic for the Federal Reserve to not be able to provide the liquidity to the world to meet the demand for dollars. That to me is far more of a problem for the Federal Reserve right now than the worry of a hyperinflation scenario. To me, it's like the liquidity crisis, trying to cure that problem. Once the demand for dollars really increases and those debts are trying to get paid off, there's not going to be enough dollars to do it. And the Federal Reserve is not going to be able to print at a pace that is fast enough to cover all those debts. And even if they did try to print up at a pace that is fast enough, they would send the United States into an unsustainable debt path, which they have already communicated saying that is not possible, that we cannot continue down this road. What it is that the Federal Reserve is going to do the next time we have a liquidity crunch coming into the future, which there will be at some point, all right, what the Federal Reserve is going to do to buy something as an asset to put on their balance sheet, I don't know yet. Right? I don't know. They have communicated in the past that they could use the debt of a sovereign nation, but that's a whole new game, a whole new type of economy, and typically the regulations and the issues of like foreign exchange and dollar value that's usually held up to the government and not the Federal Reserve. So it would create a whole new situation to be in that is hard to imagine what it would look like or even theorize on until we get there. Someone in brief words tell me what's new. All right. Not sure why comment was removed. It was reference to the thumbnail. Value dollar. The holder of debt owns the wealth. Value of dollar dropped again, 1 year low. Don't you think it's already creating a world liquidity crisis? Well, yeah, and I think in a lot of ways it does. But you have to think, liquidity crisis is the failure to achieve the liquidity crisis is the failure to acquire dollars, right? There's not enough dollars out there to get. People are hoarding onto them. So liquidity crisis, it doesn't mean that there's no dollars there. It means that there's not dollars that are just easily flowing out there. People are hoarding onto them. And generally when you hoard onto them, you start demanding a higher interest rate for it. So what you have in a liquidity crisis is the lack of available dollars, not necessarily because they're not there, but because people are hoarding onto them. And on top of that, because they're hoarding onto them, they're going to want a higher return on that. So you end up finding interest rates moving up as well. That can happen in a blink of an eye. Like, you think about it, September of 2019, that actually occurred. That very thing. There was like a liquidity crisis that had manifested itself in like literally, like they could see it coming, I'm sure. But and the reason why they could see it coming is because it was a huge tax payment that corporations had taken a bunch of cash, moved it out of the banking system, and sent it over to the Federal Reserve to to what they call the Treasury General account. So when taxes are paid, that money goes to the Treasury General account. When it's in the Treasury General account, it's not in the banking system. So this huge tax payment that had been made in September of 2019 removed a bunch of cash, sent it over to the Federal Reserve, to that Treasury General account, denying the banking system enough money to then have the overnight lending rate fall within the Fed funds rate. There was simply not enough cash in the banking system. Overnight lending rate shot up to like 10%, and the whole like banking financial system was going to freeze up the next day. The Federal Reserve stepped up and says, no way, we're going to let that happen. We got the repo facility. You're sitting on a bunch of treasuries. You give us treasuries. We'll give you cash. You can operate the next day, and we'll just keep flipping this every single day. And they refer to that as like the overnight repo facility, the overnight lending rates, or the reverse repo rate. But ultimately, it was non-QE QE. It wasn't exactly quantitative easing where they outright bought U.S. Treasury debts, but they were like essentially swapping Treasury debts for cash to keep the banks keep them liquid, keep them full of cash so that they can continue to operate the next day. That's really what ended up happening. So we can find liquidity crisis happening very quickly. Like I said, September of 2019, it was literally happened from a corporate tax payment. And again, I believe that they knew that that was coming, because if you go and watch a video that I had done like 6 months earlier, it was titled "Things Are Changing." And it literally talked about how the Federal Reserve was wanting to establish a standing repo facility, because the repo facility up until that point was just a pressure relief. It was not a common feature or a toolkit of the Federal Reserve. It was something that they had in case of an emergency, that they would deploy the standing repo facility or the repo facility, but they wanted it to be standing. And they talked about that 6 months ahead of the September 2019 liquidity crisis that had happened. So in my mind, they had it in their head that they would establish or have the ability to deploy the standing repo facility once that corporate tax payment was made, because they had to know. They had to know that there's like this corporate tax payment is going to be made and that it's going to deny these banks the cash. Like they just had to know that that was going to happen. Like they didn't like, oh yeah, the corporate tax payment. Shit, I forgot all about that. Right? No, they knew it was going to happen. And once it took place, boom, right? The problem with the overnight lending rate shot up, and the Federal Reserve was like, we're here to save the day with the standing repo facility that we talked about 6 months earlier. Right? That's how I know like they are not flying on the seat of their pants. They are well orchestrating this. Right? They have this so dialed in, and most people, like literally 99% of the people, can't see it. And I get it. I know why. It's because they follow mainstream media narrative. Once you ignore the mainstream media narrative and you dive into the monetary policy and you break down their words for what they have actually said, all this stuff starts to clear up. You start looking for the reasons why they would want inflation moderately above 2%, and then you find how it is that they are able to achieve it. Because this is what's happening, moderately above 2%. What time is it? Alrighty, guys. That went by really quick. 496 people watching with 136 thumbs up. Thank you so much for hitting that thumbs up button. We got $20.47 in super chats, because you guys are always so generous with the super chats and supporting the Uneducated Economist. Be sure and hit that like button and share the video. By sharing the video, you get the algorithm to spread the video around even more. Uneducated Economist gets to spread his information and make a little bit more in ad revenue. And for those of you who would rather listen to these videos as opposed to watching them on YouTube, there is a link down in the description to the official UE podcast where you can listen to these videos as opposed to watching them on YouTube. And I would appreciate everybody just going and checking that out. Follow the podcast. I'm trying to get more activity there, get more views or listen time, trying to get it essentially monetized, so that I basically need engagements to happen there. So if you want to help out the Uneducated Economist by just going and clicking on that link and listening to a few of the podcasts, that would really help me out. Uneducated Economist, you guys let me know.